BlackRock has executed the largest capital reallocation in modern financial history. The world's biggest asset manager quietly moved $2 trillion out of U.S. markets into international investments. This isn't panic selling or crisis response. This represents structural rotation based on mathematical analysis of global return potential over the next decade. Understanding the scale requires context about BlackRock's total assets under management. $2 trillion represents approximately 20% of BlackRock's total portfolio. Moving this amount of capital requires months of planning and systematic execution across multiple asset classes and geographic regions. This isn't quick tactical adjustment. This is strategic repositioning for fundamental changes in global growth patterns. The quiet nature of this reallocation reveals professional investment management approach. Large institutions never announce major portfolio changes publicly because it would affect prices and reduce execution efficiency. BlackRock communicated through regulatory filings and quarterly reports while avoiding media attention that could disrupt their positioning strategy. Professional asset managers execute large portfolio changes through multiple small transactions over extended periods. This prevents market disruption while achieving optimal pricing for massive position adjustments. The $2 trillion reallocation occurred through thousands of individual transactions across different time zones and market sessions. The timing reflects BlackRock's analysis showing that U.S. market dominance has peaked while other regions offer superior risk-adjusted return potential. This analysis incorporates economic growth projections, currency relationships, demographic trends, and policy environments across major global markets over 5 to 10-year timeframes. The dollar weakening represents the primary catalyst driving institutional capital outflows from U.S. markets. Currency analysis shows systematic pressures on dollar strength, including fiscal deficits, monetary accommodation, and international competition from alternative reserve currencies. When major currencies weaken, it reduces returns for international investors regardless of local asset performance. Dollar index technical analysis reveals breakdown of key support levels that have held for over 2 years. The combination of technical weakness and fundamental pressures suggests continued dollar decline that makes U.S. investments less attractive for international capital. Global investors must consider currency impacts alongside local market returns. Federal Reserve policy uncertainty creates additional headwinds for U.S. asset allocation. Markets cannot predict whether Fed policy will prioritize inflation control or economic growth when these objectives conflict. This uncertainty increases volatility while reducing predictability of returns that professional money managers require for confident positioning. Interest rate policy remains trapped between contradictory pressures. Higher rates help control inflation, but damage economic growth and asset valuations. Lower rates support growth, but risk currency weakness and inflation acceleration. This policy bind creates conditions where other regions with clearer policy directions become more attractive. International markets offer superior growth potential compared to mature U.S. economy facing demographic and debt constraints. Emerging market economies show higher GDP growth rates, younger populations, and lower debt levels that support longer-term expansion potential. Developed international markets, including Japan and Europe, offer currency diversification benefits. Emerging market growth rates typically exceed U.S. growth by 2 to 4 percentage points annually, while starting from lower economic bases that provide greater expansion potential. Countries including India, Vietnam, Indonesia, and Brazil show demographic advantages with large young populations entering productive working age. Technology adoption in emerging markets often leapfrogs older infrastructure while providing efficiency gains that boost productivity and economic growth. Mobile banking, digital payments, and renewable energy deployment occur faster in emerging markets than developed economies burdened by legacy systems. Currency diversification benefits become apparent when dollar weakness affects US-denominated returns for global investors. International assets provide natural hedges against dollar decline while offering exposure to stronger currencies that enhance total returns through exchange rate gains. Exchange rate mathematics work in favor of international investments when base currency weakens. A 10% dollar decline automatically adds 10% to foreign asset returns measured in dollar terms. This currency effect operates independently from local asset performance while providing double benefit during dollar weakness periods. Professional institutional investors operate through systematic analysis rather than headline-driven decision-making. BlackRock employs hundreds of analysts monitoring economic data, policy trends, demographic changes, and market valuations across global markets continuously. This analytical capability enables positioning ahead of events that eventually become public knowledge. Institutional decision-making incorporates probability analysis across multiple scenarios rather than single-point forecasts about future developments. Risk management frameworks evaluate potential outcomes across different economic and policy environments while positioning portfolios to benefit from most likely scenarios while protecting against adverse developments. Mathematical modeling drives institutional allocation decisions through quantitative analysis of return potential, volatility expectations, correlation relationships, and risk-adjusted performance projections. These models process massive datasets while identifying opportunities and risks that aren't apparent through casual market observation. Data access provides institutional investors with information advantages over retail investors who rely primarily on public news and commentary. Institutional investors purchase economic data services, maintain research relationships with investment banks, and employ proprietary analysis capabilities that reveal market developments before they become public knowledge. The timing advantage explains why institutional moves often appear prescient when analyzed retrospectively. Professional investors positioned for dollar weakness and international outperformance months before these trends became obvious through public market performance. By the time retail investors recognize trends, institutional positioning has already captured substantial portions of potential gains. Global ETF strategies provide retail investors with access to international diversification without requiring individual country or company analysis. Broad international ETFs offer exposure to multiple markets through single investment vehicles while providing professional management and automatic rebalancing capabilities. Emerging market ETFs typically include exposure to China, India, Brazil, Taiwan, and South Korea, while providing growth-oriented positioning in economies with superior demographic and economic trends. These funds automatically adjust country weightings based on market capitalization while maintaining diversified exposure across different sectors and regions. Japan-focused ETFs offer developed market exposure with unique characteristics, including corporate governance improvements, demographic challenges driving innovation, and currency benefits during dollar weakness periods. Japan's economy shows structural changes that could support sustained outperformance compared to other developed markets. Regional diversification through international ETFs reduces single-country risks while capturing broad growth trends across multiple economies. Europe, Asia-Pacific, and Latin America represent different economic cycles and policy environments that provide natural diversification benefits compared to U.S. concentrated portfolios. Sector diversification through international ETFs provides exposure to industries and companies that may not exist or have limited representation in U.S. markets. Technology companies in Asia, commodity producers in Latin America, and manufacturing companies in Europe offer different business models and growth drivers. The basket approach prevents individual stock selection errors while capturing broad regional trends through professional management and systematic rebalancing. International ETFs provide instant diversification across hundreds of companies while eliminating need for individual research and position management. Liquidity advantages of major international ETFs enable easy position adjustments as global conditions change. Large ETFs trade with tight bid-ask spreads while providing immediate access to international markets without complex currency conversions or foreign brokerage relationships. Cost efficiency through ETF investing provides international exposure at fraction of costs required for direct international investing. Expense ratios for broad international ETFs typically range from 20 to 60 basis points annually, while direct international investing involves multiple transaction costs, currency conversions, and administrative expenses. Gold regulatory changes represent fundamental shifts in banking system reserve requirements rather than temporary policy adjustments. Basel III banking regulations now classify gold as Tier 1 capital equivalent to cash and government bonds. This regulatory change creates structural demand from banking institutions regardless of gold price movements. The reclassification means banks can hold gold reserves to meet capital adequacy requirements instead of only cash and government bonds. This creates permanent institutional demand that operates independently from investment sentiment or economic conditions. Banks must maintain specific capital ratios regardless of market conditions. Central bank gold purchases accelerated following regulatory changes, while commercial banks increased gold holdings to optimize balance sheet composition under new rules. This institutional demand provides price support during market stress while creating systematic buying during economic uncertainty periods. International banking relationships face complications from sanctions risks and currency weaponization that make gold attractive as neutral reserve assets. Banks operating internationally seek assets that cannot be frozen or confiscated through political decisions affecting traditional banking relationships. Silver benefits indirectly from gold regulatory changes because precious metals often trade together, while silver offers lower price entry points for institutions seeking precious metals exposure. Industrial silver demand continues growing while monetary demand increases through gold spillover effects. Precious metals market structure shows permanent changes rather than cyclical variations in demand patterns. The combination of regulatory changes, geopolitical tensions, and currency competition creates systematic support for precious metals prices that operates independently from normal economic cycles. Physical delivery considerations become more important as institutional demand increases for actual metals rather than paper claims. Banks and institutional investors increasingly seek allocated storage and physical possession rather than unallocated accounts that involve counterparty risks. Mining company valuations reflect increasing institutional interest in precious metals exposure through equity investments. Gold and silver mining stocks provide leveraged exposure to metal prices while offering dividend income and operational improvements that pure metal holdings cannot provide. Technology sector exposure through international investing provides access to artificial intelligence, renewable energy, and digital transformation trends occurring globally rather than concentrating in U.S. technology companies. Asian technology companies often trade at lower valuations while offering similar growth prospects. Healthcare and consumer sectors in international markets offer different demographic exposure compared to U.S. companies serving aging populations. Emerging market consumer companies serve growing middle-class populations with increasing purchasing power and consumption patterns. Infrastructure investment opportunities exist primarily in international markets where governments prioritize development projects including transportation, energy, and communication networks. These infrastructure programs create investment opportunities while supporting long-term economic growth. Commodity exposure through international markets provides direct access to resource-rich economies and companies involved in mining, energy production, and agricultural operations. These sectors often have limited representation in U.S. markets while offering different economic cycle exposure. Real estate investment trusts in international markets provide property exposure in regions with different demographic trends, development patterns, and currency relationships. International REITs often offer higher yields while providing geographic diversification benefits. Portfolio construction, using international diversification, reduces correlation risks that affect U.S. concentrated portfolios during domestic economic challenges. International holdings provide stability when U.S. markets experience stress, while offering growth participation during favorable global conditions. Risk management through global diversification operates more effectively than domestic diversification alone, because different regions experience different economic cycles, policy environments, and currency conditions. This geographic spreading reduces portfolio volatility while maintaining return potential. Tax considerations for international investing vary by account type and holding period, while generally offering similar treatment to domestic investments through major ETF structures. International ETFs typically provide tax-efficient exposure without complex foreign tax issues that affect direct international investing. Currency hedging decisions affect international investment returns through exchange rate impacts that can enhance or reduce local market performance. Unhedged international exposure provides full currency benefit during dollar weakness, while hedged exposure focuses on local market performance. Monitoring international portfolios requires attention to different time zones, economic data releases, and policy developments across multiple regions. Professional investment platforms provide research and analysis covering global markets while maintaining focus on U.S. relevant information. The rebalancing process for international portfolios involves periodic adjustment of geographic and sector weightings based on changing relative valuations and growth prospects. Systematic rebalancing maintains target allocations while capturing benefits from regional rotation patterns. Long-term wealth building through international diversification provides access to global economic growth while reducing dependence on single-country economic and policy outcomes. Historical analysis shows benefits from international diversification during extended periods, even when short-term performance varies. Understanding global economic trends requires broader perspective than domestic focus alone, while recognizing interconnections between different regional markets and economies. Professional investors maintain global awareness while making allocation decisions based on relative opportunities across different markets. The institutional money movement represents early stage of longer-term global rebalancing rather than temporary tactical adjustment. Demographic trends, policy environments, and economic growth patterns suggest continued capital flows toward international markets over coming decade. Educational value from studying institutional behavior provides insights into professional investment approaches, while highlighting importance of systematic analysis over emotional reaction to short-term market movements. Learning from professional strategies helps individual investors improve their own decision-making processes. This analysis examines observable capital flows and institutional positioning rather than providing specific investment recommendations. Understanding these professional approaches provides educational context while recognizing that individual circumstances require personalized analysis and professional advice for optimal implementation strategies.